Jennifer? Are you muted?
What was that? I cannot hear you. No.
I can't hear you, Emily, if you're talking. There you go.
Okay, I can hear. Can you hear me?
Now we can, yeah.
Okay, okay, thank you. So we're gonna just hang out for a couple more minutes. I know there are a few more people registered and we'll wait until noon for us to formally launch, but I'm excited that you guys are here. I think this is going to be full of some really valuable stuff for you today. Hi, Connie.
Hello. Hi, Emily. Can you hear me?
Yes.
Awesome. Okay.
Okay, good. You can hear me too.
Hi, sorry, I'm gonna be in and out here.
That's okay. Hi, Emily.
Hi.
Hey, Connie, I got your email. I'll come by probably around 3 o'clock or so to your office and grab that deal.
Perfect, Ryan. Emily, how many people are you expecting for this?
We actually have about 20 people registered.
Very good.
I know. Yeah. Oh, here's Clay. And Judy. Awesome. Hi, Clay. Hi, Judy.
Hello.
Okay, it's noon, so we're gonna get started. And I see a couple more. If a couple people pop in, Cheryl just joined us. I'll make sure to admit them. So I want to welcome you all today to our second Lunch and Learn. And I really am grateful for Kyle and Jennifer from Cordell, Neher Company doing this today. Thank you guys. I know it's already tax season and you guys are in the thick of it, and it's only going to get worse from now until April. So thank you so much for doing this today. They are members of the association and they're based in Wenatchee. So Kyle and Jennifer are both CPAs and have a lot that they're going to be sharing with us today, especially of just things for you guys to all be thinking about and different ways to help make preparation for your tax season better. Also know that you can reach out to them for help and to hire them and have them, support you in your books and your accounting. The one important thing I need to mention, since our insurance professional Ryan Moore here is on the call, is that this is information for you. It is not specific to your business per se. So you might learn some things, but don't automatically assume that there are, well, I guess how I should say it is, things are going to be different for every business. So a little nuanced for your particular situation. And Kyle and Jennifer are going to be giving us some nice overviews and things to know about, but specifically to your situation, you should be working with your own accountant and bookkeeper. And if you don't have one, you can work with them. As Ryan is saying, this is informational purposes only. So I hope you take away something from it. and know that these are some of the experts here for you to turn to for more specific advice for your particular situation. Okay, with that out of the way, I would like to turn it over to Kyle and Jennifer to introduce themselves and share more with us.
Thanks,
Thank you,
Emily.
guys.
Appreciate you guys having us today. Even though it's tax season, we like to get out and help out and get information out there that can help people. So this is kind of a quick rundown of our firm. Like you said, we're located in Wenatchee. We're one of the bigger firms in Wenatchee. We serve businesses all over Washington State. So we're big enough to help, but small enough to still care. So a good sort of dynamic there. I've worked at a lot of firms, and it's good to have that, or a few firms, I shouldn't say a lot. It's good to have that that split of being big enough to take care of things, but not too big. So here's a quick rundown of what we're going to talk about. I won't get into these individual bullets, but there it is laid out. And we also have a disclaimer right built into our presentation, and it's in a nutshell almost exactly what Emily already said. This is general guidance. You should consult a tax professional to see how this really fits your specific situation. So that's what that says in a nutshell. I won't bore you by reading the whole thing. I will tell you a little bit about myself. I've been in public accounting more than 15 years, we'll call it. I started out my career over on the west side. I actually spent 10 years working in Yakima, and I've been in Wenatchee for about 3 years now. So I've been, like I said, a few different firms. I've seen a lot of different things in public accounting. So that's my history in a nutshell. Jennifer, if you want to jump in and tell us about yourself, and then we'll let Jennifer kick us off with talking about books and payroll setup.
Sure. So I am currently a manager with Cordell, Neher Company. I've been in public accounting for about 10 years. I actually started at the firm as an administrative assistant, and then went and finished my schooling, and now I'm a CPA here. My specialties include small business taxes, bookkeeping and payroll taxes, individual taxes and consulting, and then I do actually a lot of work with nonprofits in the area. So I'm going to start talking about sort of the initial books and setup, and how you would maybe select a software platform to use for keeping track of your business activities. The most common platforms we see are definitely QuickBooks based, Intuit QuickBooks. So that's what I'm going to talk about for the most part. And then you have sort of the base decision there between whether or not you want to use QuickBooks Online or a desktop version of QuickBooks. There's sort of pros and cons between the two. Online definitely gives you better remote access. You can download an app on your phone. You can access it from any computer you want to, because it lives in the cloud. And so you're not really tied down to having the program on one computer. Desktop, on the other hand, is a license that you buy. It's installed on a machine, like in your home office. And then for the most part, that is typically the only place where you can access that QuickBooks information. There are options there to pay for some hosting services. If you would prefer to use the desktop version of QuickBooks, you can pay a subscription to host that file in the cloud. And then that does make that file more accessible from different locations. So that'd be a good option if you were using a desktop file and you wanted to maybe share access of that with your accountant or bookkeeper. That would be an option. Desktop version definitely does have some more robust payroll functions. So if you have maybe a more complex payroll setup, you'd probably want to lean more to a desktop version for your setup. But online will definitely do, you know, more of the day-to-day payroll processing and form processing that you might need. So part of your QuickBooks setup also is creating a chart of accounts. Your chart of accounts is basically how your transactions are getting recorded in the software. So most bookkeeping packages, QuickBooks included, when you set up that file, the initial setup, you typically can select which industry you work in, and then the chart of accounts is usually tailored for that industry. So in the initial setup of that file, if you chose the construction industry, it's going to have accounts like cost of goods sold, you know, probably vehicle expenses, tools expenses, things like that that are pretty typical in your industry. So just keep an eye on that when you're setting that up. It's also pretty important that you keep track of your 1099 vendors. So as kind of a good rule of thumb we like to encourage people to follow is, you know, get a W-9 from your contractors and other service providers you might pay before you pay for their services. That just makes sure that you have your bases covered when year end comes, and you're, you know, scrambling to get those 1099s filed, and you're not having to get W-9s in January when everybody else is trying to get their year end work done. So a 1099able person, there's a lot of rules that go into whether or not you have to issue one to somebody. If you want some more information on that, you can email me. As a general rule, if it's a corporation, so if it has incorporated at the end of its name, you don't have to issue 1099s to those people. If it's an LLC, you need some more information from that entity, which would come in the form of a W-9 to determine whether or not you would issue a 1099 to an LLC. A sole proprietorship, you're pretty much always going to issue a 1099 for. And then typically like public accounting firms, legal firms, pretty much always going to issue 1099s for those guys. And those would be for payments in excess of $600 in 1 year, is when you hit that 1099 reporting requirement. So pretty important to not ignore that responsibility. There is actually pretty stiff penalties the IRS will impose if they've found that you have willfully disregarded your filing requirement with regards to those information returns. I want to say it's over $500 per form that you were required to issue and did not for a willful disregard. So pretty important rules to follow there. So after you get your QuickBooks all set up, and maybe you're going to hire some employees, there's some certain steps that you want to follow in that process. First is you would apply for an EIN. You can do that right on the IRS website. It takes about 10 minutes probably to do that process. Then for the state of Washington, you would fill out what's called a master business license. Again, you can do that online as well. And if you already are operating in the state of Washington, they've already issued you a UBI number, but you didn't indicate at that time that you were hiring employees. And this second master business license is almost like an amendment to the first one to say that you're now hiring employees. And then going through that process is what actually opens up your accounts with the different state payroll tax agencies. So there's Employment Security Department for the unemployment insurance. There's Labor and Industries for the workman's comp coverage. And then there's the Employment Security also administers the paid family medical leave tax that was imposed at the beginning of 2019. So once you get all those accounts set up and open, you'll want to activate your payroll subscription in whatever bookkeeping software you're using, and then set up your payroll items, like your gross pay items, bonus items, tax deductions at whatever rates you're assigned by those state agencies, et cetera, et cetera. So as kind of a different option to doing payroll yourself, you could also opt to hire an accounting firm like us to do that for you. You could use a third-party payroll processor like an ADP or Gusto. Those services will also automate your quarterly and year-end tax filings with regards to payroll taxes. So those would be a decent service to look into too, if you feel like you don't want to try to tackle the payroll yourself. And then if you do decide to take that responsibility on yourself, definitely making all of your payroll tax deposits for both federal and state agencies timely. So the federal payroll tax deposits, those are actually considered funds and held in trust. And so if you fail to make those, the penalties for those are 100% of the unpaid taxes that were held in trust. So very, very large penalties if you disregard your payroll tax deposit obligation with regard to federal taxes. And then again, there's also some quarterly and annual reporting requirements with regards to payroll filings. So all of the state reports are filed on a quarterly basis. Form 941 is a federal form that's filed on a quarterly basis. And then at the end of the year, you have your W-2 requirement that you have to furnish to employees and file with the Social Security Administration. And then you also have a year-end form, a 940, which is the federal unemployment tax form, and that is an annual form as well. And like I said, if in doubt, this could be pretty complicated stuff. Hire a professional to help you with these things.
Okay, with that, I'm going to talk a little bit about entity structure. So basic discussion of the entity type. So these sort of run from least complicated, least amount of liability protection to most. So sole proprietorship is just basically operating under your own Social Security. If you have payroll, you do have to apply for an EIN for payroll, but everything runs through your personal tax return. Any net income of the sole proprietor is subject to self-employment tax, which is a little over 15%. So that's kind of an important thing to keep in mind as we go through these items. So limited liability and the sole proprietorship doesn't offer any sort of liability protection. So if you're functioning in your role as a sole proprietor and you crash your car into somebody, all of your personal assets would be at risk in addition to anything in the business. So no liability protection whatsoever as a sole proprietor. It does offer you the most sort of flexibility. You don't even have to have a business bank account if the bank doesn't require it. There's no restrictions on money going in and out or commingling between business and personal funds. Obviously, that's not really a best practice when it comes to bookkeeping and tax record keeping, but is the IRS gonna get after you for commingling personal and business funds? No, they're not, but there's going to be other reasons you're going to want to keep those sorted out. But as a sole proprietor, no liability protection, tons of flexibility, probably most expensive tax-wise. Moving into an LLC, so this probably provides the most flexibility, and it does give you some probably cheap liability protection. In order to get that liability protection, usually we recommend that you open a business bank account so that you can show that there is a division between yourself and the LLC. What's at risk, assuming the hypothetical car accident, would be anything that's titled in the LLC's name, so the bank account, the car, whatever other assets are there. Your personal assets that are outside of the LLC probably are not going to be at risk. It's not always 100%, but there is a lot more protection there using the LLC versus being a sole proprietor. And the nice thing about the LLC is if it's a single member LLC, so you just form this, you're the only person in it, it can be taxed as a sole proprietorship, so you can get some liability protection, but it doesn't change tax filing requirements. There's no additional income tax return required. So if you're a smaller taxpayer, don't have enough activity to think about maybe being a corporation, You can start out as an LLC, get some liability protection. And then the beauty of the LLC is you can change your mind after the fact, and you can elect to be taxed as an S corporation or even a C corp if you wanted. If you have multiple members in an LLC, then it'll be taxed as a partnership. So really, the partnership is, if it's not an LLC, it probably doesn't offer any liability protection. At its base, it's two people in a sole proprietorship would be a partnership. It can get really complicated depending on what your partnership agreement says, how the income is going to be split, what happens. So partnership taxation is the most complicated section of business tax. So there's a ton that goes into it. There's a ton of flexibility there. If you have more than one person that's in an LLC, it's taxed as a partnership by default. An LLC or a partnership can elect to be taxed as an S corporation. So the reason you might want to be an S corporation as opposed to a partnership is the income, generally the income from a partnership is also going to be subject to self-employment tax. And an S corporation, and then, so for partnerships, S corporations, the net income each year is going to flow through and be taxed on your own personal income tax return. So partnerships and S corps most of the time don't pay any tax on their own. There's some situations where that can happen, but as a general rule, partnership and S corporations don't pay income tax. The income from those entities passes through to your personal return and you pay the tax. Partnership income, if it's for basically not a rental or investment purpose, is going to be subject to self-employment tax. S corporation income is not going to be subject to self-employment tax. So I guess the reason that you wouldn't want to automatically file that S election for your single member LLC is because as an S corporation, you have to pay the owner's wages equal to what you would pay somebody else to do that job. And those wages are subject to self-employment tax. So the net income of the S corp is not subject to that self-employment tax, but you still have to pay yourself wages, which ultimately are subject to the same tax. So you have to take what's called a reasonable wage out of the S corporation. If you don't, and you take distributions out, the IRS can come back after the fact and say, hey, you didn't pay yourself a wage. All this money that you took out, you said was just an owner distribution. It's really wages. Now you owe us back payroll taxes. And like Jennifer said, those get expensive really fast. And the late penalties and interest add up really fast on those. So that's something that you really want to avoid. And then the other reason to think twice about filing that S election, we'll get into a little bit of the finer details of this later, but there is a 20% deduction for income from a sole proprietorship, LLC, or S corporation. It's called the qualified business income deduction. If you're a sole proprietor, you get that 20% based on just the net income. The S corporation has to deduct the wages that it pays you and then takes 20% on that net number. So if you're if your wage is similar to the net income of in total, then you may be better off being a sole proprietorship because your 20% deduction is going to be larger. So from a tax standpoint, there's a lot of things that come into these. It's not as simple as saying, okay, I'm going to start out and I don't want to pay self-employment tax, so I'm just going to be an LLC and I'm going to file an S election. Typically, we look to see what kind of net income that our clients are projecting before we file that S election. So oftentimes, what we recommend is that you start out as an LLC, and then we work with you, project what your income is going to be. And the other nice thing is you can file what's called a late S election. So you don't have to file it. You don't have to file January 1st of 2020 to be an S corp. We're filing those today for 2020. But you do have to know before the end of the year because you have to pay that wage out. So that's the hang up on, well, why don't I just file an S election, in March when I'm filing my return? Well, now you haven't paid yourself a wage for last year, so that could be a problem. Like I said before, the sole proprietorship, LLC, and partnership does offer the most flexibility as far as distributions, taking assets in and out. We typically don't recommend that you put appreciating assets or real property into a corporation, because if you take them out to the extent that the fair market value exceeds the corporation's basis, it triggers a gain. So you could put a piece of property into the corporation, it sits there for 20 years, it appreciates, and all you want to do is get it out of the corporation but not sell it. You've created tax for yourself with no cash to pay the tax. So we like to put the appreciating property in an LLC or a partnership, because you can go in and out of there without causing a tax problem. The C corporation pays tax by itself. It pays tax at a lower rate generally than you would. The downside is that when you take money out, it has to be a dividend distribution to you, which is subject to tax. So the C corporation is what we call double taxed. That's the big disadvantage to a C corp versus an S corporation, partnership, LLC, or sole prop. And it has the most restrictions on putting things in and out, and especially getting money out. In an S corporation, to the extent you have basis, which is any money that you put in plus any tax you paid on income, you can take tax-free distributions. It causes a problem if you don't pay wages, but there's more flexibility in the S corp. The income's only taxed once, and you can get cash out. So generally, use an LLC first till you get going. Your operating assets, then you're probably going to want to put into an S corporation. If you have real property or other appreciating items, you put those in a partnership or an LLC for flexibility, and then lease them to the S corporation if it needs them to do what it's doing, or just keep them separate. So that is an overview on entity structure. And with that, I will let Jennifer talk to you a little bit about revenue sources.
So Kyle, real quick on the entity structure, what about if me and my spouse form an LLC? What is the sort of default treatment of that?
Default is going to be treated just like a single member LLC, but you can elect to be taxed as a partnership. So husband and wife LLC has even more flexibility than just a single member LLC.
So different revenue sources that people in your industry might see would be an either retail or a wholesale sale. So I wanted to discuss these because some people don't really know the difference when it comes to reporting your revenues to the Washington State Department of Revenue and how those sales are classified. So retail sale is typically when you are charging the end user or the customer for your services. And you are only allowed to use your reseller permit when the materials you're purchasing are for a sale at retail to that customer. So the reason is because you're going to charge sales tax to that customer for your labor and your materials cost. So if you were paying sales tax at source when you bought those things from Home Depot, the state of Washington would basically be getting double the sales tax for the one sale of that material. So that's when you would use your reseller permit. A wholesale transaction is typically if you're a sub of another contractor. So if you're an electrician as a sub on a house build and you're billing the general contractor for your service, then that is a sale at wholesale. And you would not collect and remit retail sales tax in that transaction. And then also you want to be aware of the differences between speculative building or spec building and a sale at retail or wholesale. So spec building means that you, the general contractor, own the land that you're building a house on. And when the house is done, you are going to sell a land home package. So in that sort of transaction, you are not charging the buyer of that package sales tax on that transaction. Instead, Washington State is getting their money via real estate excise taxes when you sell that property. So then you would also pay sales tax at source on any materials used to build that home. So you would not use your reseller permit on a spec building transaction. Kyle?
Okay, I'll talk to you guys about a few tax deductions that I think you might be interested in. And feel free to shoot something in the chat if you have something that jumps to mind, and we'll have some time here at the end to answer any questions too. So we tried to make this a few less slides than normal, so we made sure to have some time at the end. So the first one will be vehicle expenses. So you can choose whether you want to take your actual costs versus your standard mileage rates. At the end of the day, if the vehicle is your only vehicle and you're using it for personal and business use, you probably should keep track of your mileage anyway. The standard mileage for 2021 is 56 cents a mile. There's some pretty good apps out there to use for tracking your miles. Mile IQ is one that I've seen a few times, and it spits out a pretty nice report at the end of the year. It shows all your trips. You can put, so one thing the IRS likes to see is the business purpose for the trip, starting and ending odometer mileage, who you talked to, where you went, some basic details to substantiate why you needed to take that trip. And the reason you're tracking your mileage, even if you think you're going to take the actual costs on your combined business personal vehicle, is that you have to allocate, take the business percentage times those actual expenses. So if you spent $5,000 on repairs and fuel and everything else, but you only use 50% business, then you're only going to get to deduct 50% of that. And you do want to have those records ahead of time if the IRS comes knocking and asking about those auto expenses. They want a contemporaneous records for your mileage. So I'll talk a little bit more about depreciation on vehicles and how that sort of interacts with the mileage deduction here in a few minutes. But basics of vehicle expenses is keep track of your mileage on a combined business personal vehicle. Probably use an app. Keep track of all the expenses, repairs, fuel, insurance, all that stuff, so that you can add it up at the end of the year, take the business use percent, and then you can also compare what your business use would be against that standard mileage. So there's some options there, but definitely you want to keep track of the mileage that you're driving for business and personal. If you have a vehicle that's clearly only business use, a truck or something that you park at your office and drive from your office to the job site and back, you don't have to keep track of the mileage. The IRS is going to cut you some slack on that. They typically don't allow commuting. So from your house to the first place where you work for the day, and from the last place where you work for the day back home would be your commuting mileage. And you would not include that in your business mileage. If you have a home office and you start your day in your home office, then you would be able, then your sort of foot commute has already started, and you would include that. And then if you spend a few minutes working in the home office afterwards, then you've already started your day and started the clock running on the mileage. So something to keep in mind. You can also deduct, if you're leasing a vehicle, you can deduct the lease costs. There is they call it a lease inclusion amount. It's a really small number. For 2021, for a $66,000 vehicle, it'll be $89. So you deduct at least all of the business use percentage of the lease cost, and then you would add that $89 back into income. I guess the IRS wants to make sure that you're not getting away with too much, and $89 apparently to them is makes it so you're square. So kind of a funny little quirk to the tax code there, but something to keep in mind. Another thing, like I said, you can have a home office. You have to measure the square footage of your house that you're using solely for business purposes compared to the total. And there's a couple ways you can do it. You can take that percentage, multiply it out by your utilities, your homeowner's insurance, mortgage interest if you're paying it, rent if you're in a rental, property tax, and whatever that number is, you get a deduction against your business income for. If you are a partnership or an S Corp, you should have, or a C Corp, you should have the entity reimburse you for that. That wouldn't be taxable to you, and then the business entity would take the deduction for it. If you're a sole proprietor or a single member LLC, then you don't have to worry about getting that reimbursement, but doing that reimbursement helps to substantiate that deduction, makes it a little easier. There's also a simplified deduction available, and that is $5 per square foot up to a maximum of $1,500. One, I guess, note of caution on that home office deduction. I was going through an IRS audit with one of my clients, and the agent disallowed her home office deduction because she told her that she occasionally opened her mail and paid her bills from her desk in her home office. So they're pretty picky about, or they can be pretty picky about that business use percent use, and theoretically any personal use can not allow that deduction for the home office. So it might make sense to set up another desk or table to open your mail at, so you can keep that deduction. Meals and entertainment. So that was an exciting change from the tax bill that passed in December. For 2021 and 2022, we get 100% deduction for meals purchased from a restaurant. So this was the famed 2 martini lunch deduction that everybody's been talking about. Entertainment is much more restrictive if you're at a entertainment venue, so golf course, baseball stadium. You're going to have a hard time getting a deduction for those costs. So you want to separate out meals and entertainment on your chart of accounts, so that when it comes time at the end of the year to do your tax return, we know what's what. Your cell phone, depending on how you're structured, if you're a sole proprietor and you have one phone that you're using for personal and business, you're supposed to allocate between business and personal usage. At very least, you should allocate by line. So if you have a family plan and one person is working for the business and 3 aren't, you would at very least want to allocate only 1/4 of the cell phone bill as a business expense. Technically, you're supposed to go through a call log and allocate even further, but that's getting pretty nitpicky. At least you could come up with a percentage that's reasonable and allocate based on that. If you have an entity and you're working for your entity, the employer can pay for your cell phone, and any personal use is considered to be de minimis. So the entity gets the deduction, you don't have to pick up anything in income, and everybody's happy. So if you do use a partnership or an S Corp or a C Corp, having the phone bill in the business name is going to be a big benefit to you. That being said, if you have your kids, your cousins, your spouse, and none of them are doing anything for the business, that's going to be a red flag, and that's probably not going to be considered de minimis. So don't try to deduct too much when it comes to some of these things. Health insurance, if you're in a sole proprietorship, you can deduct the health insurance actually on page 1 of the tax return. As a partnership owner, it also is relatively easy. There's a little bit more finagling to get the deduction, but it's going to be, for all of these entity types, it's going to be deductible. They call it a self-employed health insurance deduction. In an S corporation, the tax treatment for the health insurance is really weird. The S corporation deducts it. They include it in your W-2 box 1 income as an owner. So then you're including it in your W-2 income. The S corporation doesn't pay any payroll taxes on it. And then you take a deduction in a different place on your personal tax return. So at the end of the day, you get to deduct it, but it's a roundabout way to get there. And it's one of the areas that we see small businesses sort of struggle with getting their W-2s correct, because it's such a weird way of accounting for it. And it kind of doesn't make sense, but unfortunately, that is the way that the IRS treats that. We'll talk in a minute about tools and equipment purchased by contractors when we're talking about depreciation and some of the ways that we can deduct things, either via depreciation or other ways. And then finally, you can do retirement contributions. You can get a tax deduction for your retirement contribution, either as an IRA, a SEP IRA. You could set up a 401k. There's a lot of ways that you can make tax deferred contributions to your retirement. Get a deduction today to reduce your tax. So that can be a benefit. A lot of those things you don't have to do before the end of the year. So if you get to the end of the, or you're filing your tax return and you have an unpleasant surprise with the tax balance due, you might be able to make a retirement contribution or an HSA contribution if you have an eligible health insurance plan and bring that tax down. So something to think about. So depreciation, this would be where you might deduct some of your tools or equipment, depending on the dollar amount. So we have a couple methods this year, 2020, 2021, 2022, that we can expense items that we put in service. So we can take a 179 deduction for it, which is 100% deduction for whatever it is that you're buying. The limit is about $1 million for 2020. So a lot of potential there. You can also take 100% bonus depreciation. Before, it used to have to be brand new to qualify for bonus depreciation, but for the last couple years, used equipment qualifies as well. So 179 and bonus both let you expense 100% of the cost of whatever it is that you've purchased in the year that you purchased it. So for heavy vehicles, which is defined as over 6,000 pounds gross vehicle weight rating, you can take 179 or bonus, whichever one suits your fancy. If you have an SUV or a truck with a bed under 6 feet, there is a little bit of restriction on that. You can take up to 25,000 of 179 and bonus and regular depreciation up to $18,100. So if you buy an SUV or truck over 6,000 pounds gross vehicle weight rating, your maximum deduction is going to be $43,100, depending on what the cost of it was. There's some pretty restrictive depreciation limits for vehicles that are under 6,000 pounds gross vehicle weight rating. That 18,100 would be the limit for the first year in service for anything that doesn't meet that weight restriction. But there's quite a few vehicles that do qualify for that. So, and then some reasons, some quirks to 179 versus bonus. So if you purchase something, you're using it 100% for business, say it's your truck, and you stop using it for at least 50% business purpose, you may have to recapture that 179 that you previously deducted. So it would trigger potentially some income to you. Again, income where you haven't gotten any cash, which is the worst kind of income. Never fun to pay tax on income where you don't have the cash. And then 179 basically lets you choose whatever amount that you want to expense in the current year. So if you bought a piece of equipment for $50,000, you can take 179 depreciation for $1,000 to $50,000. Your choice, whatever works the best for your tax situation. 179 also can't create a loss. So if you buy that $50,000 piece of equipment, but you only had $25,000 of income, you're only going to get $25,000 of depreciation in the current year, but the $25,000 is going to carry over to the next year and until you have income to use it out. And that works a little better, especially for sole proprietors, than creating a loss with bonus that carries over as a net operating loss, because those net operating losses, A, have an 80% limit on the income they can offset, and B, don't offset self-employment income. So you sort of make a self-employment loss in year one, but when you deduct it in year two, all of a sudden you don't get to offset the self-employment tax. So you may not have regular tax, but you can have kind of a nasty surprise with the self-employment tax. And you may be able to avoid that by using 179 instead of bonus. Bonus depreciation is harder to dial into the exact number you want because you have to elect in and out by what's called class life. So if say a truck is 5 years, a backhoe is 7 years, you could elect in or out for the truck and everything else that's 5-year property, or the backhoe and everything else that's 7-year property. But you can't say if you have a backhoe and or two backhoes, you can't say I want to take bonus on one but not the other. So that's sort of one of the restrictions on bonus. It's a little harder to dial in that income number to be exactly what you want. But we do sort of use these to work together to get to where we want to get to. And then there's a couple other ways that you can get around even having to bother with 179 or bonus depreciation. So the first one is the de minimis election. So this lets you write off the bat any item that's under $2,500. So it's under $2,500 per item or invoice. So if you buy 5 computers for $2,000, even though you wrote a check for $10,000, because each computer itself is $2,000, you can write them all off. A side benefit to that is that you eliminate potential depreciation recapture if you sell your computers. Usually computers aren't an issue because usually we're not making anything when we sell them, but if you do depreciate something, so you buy your computer for $2,000, you take a deduction for the full $2,000 or $3,000, enough to get us over that de minimis election. You write off the whole $3,000 and you sell it for $500, say 3 years down the road. Because your basis now is zero, because you've written it all off, that $500 will be ordinary income. So that's where you eliminate that depreciation recapture by using this de minimis election. It's more beneficial for buildings and other sort of appreciating assets than it is for computers, but that's a sort of a basic example of that. There's a small taxpayer safe harbor election. which is for real property. Real property with basis under $1 million. If the total that you're using for repair, that you're spending for repairs and maintenance is less than 2% of the unadjusted basis for the building, or $10,000, then you can write it all off in the current year. If you pay for routine maintenance for your buildings, as long as you're reasonably expected to do the maintenance more than once every 10 years, you can take it as a deduction in the current year. So a couple ways to get around even having to bother with some of those depreciation items. That de minimis election is especially powerful. We use it for almost all of our businesses. And that actually is a year-by-year election. So if for some reason you decide that you want to increase the taxable income in a business in 1 year or capitalize something, you don't have to make that every year. So another way that we sort of try to manage our business taxable income. So this 199A qualified business income deduction, like I was telling you before, you get a deduction for 20% of your combined qualified business income. If your total taxable income is over $315,000 for married filing joint or $157,500 for single taxpayers, there can be some limits. Rental property can qualify for this, assuming you keep separate property books and records. Somebody, doesn't have to be you, spends 250 hours working on the property. And again, the records have to be contemporaneous. So this is a nice benefit for sole proprietors, partnerships, and S corporations. C corporations got a reduction in tax rate, and this is what those small business entities got to sort of offset that. So Jennifer is going to talk to you guys a little bit about the employee retention credit.
Yeah, so I want to begin by saying this credit is very complicated. So I'll kind of touch on just high-level requirements for taking the credit and if you might qualify. So the employee retention credit was created as part of the CARES Act in response to the COVID-19 pandemic. And it is basically a refundable credit against certain employment taxes, and it will also offset wages. So the credit period for the first round of credit is from March 12th, which is when the COVID-19 disaster was declared, through the end of December of 2020. And the credit is equal to 50% of qualified wages paid to employees of up to $10,000 per employee per year. So that translates to up to a $5,000 credit per employee per year if you meet the requirements for this credit. And then the CON Act that was passed late in December, the Consolidated Appropriations Act, expanded the ERC through second quarter of 2021. And it also revamped the credit to increase it to up to 70% of qualified wages paid to an employee of up to $10,000 per employee per quarter. So the credit there for first quarter and second quarter of 2021 could be up to $7,000 per employee per quarter for each of those quarters. So pretty substantial figures there. And how you would qualify for that credit is you must have had your business operations either fully or partially suspended due to government order. Inslee's shutdown of construction activities between March and June would qualify a lot of you people probably. Or you suffered a decline in gross receipts in any calendar quarter in 2020 as compared to the same calendar quarter in 2019. And that decline has to be at least a 50% decline in 2020 or a 20% decline in 2021. So for example, if in quarter 3 2020 your revenues decreased by a greater than 50% as compared to quarter 3 of 2019, you would qualify then for the employee retention credit for that quarter. Like I said, we've been reviewing some of our tax clients' qualifications for this credit as we're working on their tax work. And we've noticed that several clients haven't taken this credit who are eligible, and it can be quite substantial. We've gotten credits for some of our clients that are over $100,000. So it adds up very quickly. Definitely you should look through your QuickBooks file. If you're using QuickBooks, you can pull a profit and loss report that shows a previous year comparison. And that will very easily tell you there if your revenues have shown decline. And again, if your business did suffer shutdown during that period, you would qualify then automatically for that quarter. If you also got some PPP funds, which Kyle's going to talk about next, the wages used to satisfy the forgiveness on the PPP cannot also be used to take an employee retention credit. So there's some calculation considerations there. And so Kyle's going to talk about PPP next.
So I guess I would also point out that this being a refundable credit means they're actually going to send you a check. So not just refundable when you use your 941 to apply for this. So if you already filed your 941s for 2020, but you might qualify, which tons of businesses were closed down at least under the governor's order. So you qualify during that period, you amend your 941, and the IRS is going to cut you a check for 50% of your wages, up to $10,000 per employee during that period. So this is potentially huge for a lot of people. So really double check to make sure if you haven't taken it that you don't qualify. So the Paycheck Protection Program, we'll try to go through this pretty quick. This is a forgivable loan for businesses and employees and self-employed contractors who are in operations February 15th, 2020. So this loan amount is 2.5 times your average monthly payroll for 2019 or 20, depending on which one's larger, or your net self-employment earnings if you're a Schedule C self-employed contractor. If you spend it on any of these expenses listed here, so payroll, mortgage interest, utilities, rent, operations, computing expense, property damage, supplier costs, and worker protection expenses, they're going to forgive the loan. So this is free money in essence. The payroll has to be 60% of the amount forgiven. That's the one hiccup, unless you are a self-employed contractor, and then you're going to get forgiveness because they're giving you a loan basically to pay yourself for owner's compensation. So you get automatic forgiveness for the portion that's related to your net earnings from self-employment. If you have employees and you reduce your headcount, your forgiveness can be reduced, or if you decrease your employees' pay rates. So a couple exceptions to that is you try to bring your employees back and they say no and you document it. This second one is the big one. If, because you're complying with the government shutdown order, you cannot return to the same level of business at February 15th, 2020, then you get an automatic free pass for not bringing your employees back. This February 15th date, you'll notice, is pretty important in a lot of these COVID relief items. If you fire an employee for cause during your covered period, you had an employee voluntarily resign, or they sort of stepped down, requested a reduction in hours or pay, then you get an exception to reducing your employee headcount. So you would potentially still get full forgiveness if you spent the money like you're supposed to, but you dropped your employee count. So now there's also a second draw on this PPP program. In order to qualify for the second draw, you had to have gotten a first draw loan, and you had to have a decline in revenue in 2020 in any quarter by at least 25% compared to the same quarter in 19. Hospitality businesses get a little more the second go around. Small businesses get another chance to take a first draw if they missed out the first time. So if you didn't get a PPP loan first time around, you can still get it now. So free money is always good, right? And then if you did take a loan the first time, but you returned or repaid part of it, you didn't accept the full loan amount, or this last one, the SBA issued guidance saying that contractors, self-employed folks can get a loan based on that income from self-employment, but they did it after they started taking applications. So some of those folks applied for loans only to find out later that they really qualified for a larger loan. They can go back and ask for more on their first draw. In order to take the second draw, you do have to spend all of the first draw on qualified expenses. So one caveat, it doesn't have to be forgiven, but you do have to spend it all before you qualify for that second draw. You apply for these through your bank or a bank or an online bank, not through SBA. So the bank's the one sort of running the show on these, but this is money that the government's going to give you to pay your employees and your other qualified costs. It ultimately should be forgiven. The IRS came out after the fact and said any forgiveness on these loans isn't going to be taxable, and you get to deduct whatever expenses you paid with it fully. So it's free money and no tax. So really good deal for taxpayer on these PPP loans. With that, we've used most of our time, but I think we can stick around a few more minutes to take questions.
I have a question.
Okay.
It's not so much on business, but I know last year they changed like this is regarding a W-4 that was sent out. I mean, employees needed to fill out that form. It's pretty confusing. And so, correct me if I'm wrong. I'm thinking that the IRS is not wanting to give a lot of tax refunds. And so they kind of calculate this new W-4 makes it so that the people get more in their paycheck and based on their income, and it's aligned closer to an even amount at the end of the year, so that they're not really paying a bunch of more taxes, but they're not getting a big refund back. Is that correct? Is that?
Well, the W-4, it was new. There wasn't any sort of requirement that employees just fill out the new form. If they had, whatever their exemptions and stuff were set out based on the old form, QuickBooks in particular was set to migrate those over based on the new W-4 format, and then adjust to the withholding tables automatically based on whatever their old W-4 was. But yes, I have noticed that the new form is very confusing. It has, I think, in payrolls that I've looked at, resulted in lesser withholding throughout the year so that people's refunds are smaller. There is an option there towards the bottom of the form where it's line 4C, where the employee can specify still if they want any sort of extra withholding on a per pay period basis. So if they feel like they're being under withheld, maybe you just have them fill out a new form. I've been telling people just sort of ignore like the step 3 portion, check if you're single or married, and then put in some extra withholding of $25 or $50 a pay period if they, kind of rely on that larger tax refund at the end of the year.
Well, for example, it's my, I'm talking, I have this little family, and the husband changed jobs, and they're like, I looked at their pay stub, I'm like, he's making good money, but they're only taking like $300 out for Fed taxes. I'm like, right. That is not enough. You're probably gonna have to pay a big amount April 15th next year. And so I don't know how to have them corrected other than maybe using that 4C to add extra. But would you kind of calculate what tax bracket they're in and say, put in an extra 10% at least or something?
Yeah, I mean, you could look at, the IRS publishes the withholding tables so that he can sort of look up based on his gross pay and how he's filled out the W-4, what his federal withholding would be for each pay period. And then he could also reference the income tax brackets too, and then kind of estimate what his taxable income would be, you know, based on where, you know, what his tax would be on his taxable income based on those brackets, and then go back to the withholding tables and decide from there if he would have to withhold a certain amount each paycheck to, you know, get him so he's at least breaking even and not owing at the end of the year.
And you don't get deductions for having children either anymore, do you? You just get that
Not
flat
a deduction,
25?
it is a child tax credit. And that is, I think, taken into account on the form as well. So if he's filled out, you know, that he's getting, if he has 3 kids and he's getting a $6,000 child tax credit and he put that on the W-4, that is going to reduce his withholdings.
Okay, that's probably what it is. Okay, thank you.
If a business received the first round, or my business received the first round of PPP, and then has already filled out the forgiveness, received forgiveness, and I think this was sometime in November. At the time, the way the SBA had it set up, or the law, or the whatever, is that the EIDL was not part of the forgiveness. And then I have read that they have now updated that the EIDL loan would also be part of the forgiveness. So I'm just wondering, if that makes sense? And if I've already paid the EIDL, repaid the EIDL loan, will I be receiving, say, a check from the bank or from the SBA for that amount?
For the EIDL, the credit that you got?
Yeah, so even before the PPP, I don't know if this was like February, whatever date it came out. So my company applied for the EIDL grant.
Right.
And I did not apply for the loan through EIDL because I was planning on going for the PPP, and I did. But in the calculation, when I went to apply for forgiveness, I was forgiven all but the EIDL amount.
So I think you're going to have to talk to your bank to work on to getting that forgiveness, because that came with that last tax act that passed like December 27th. So up until then, that EIDL loan actually reduced your loan forgiveness. But then they passed that and changed the rules after the fact, like they really enjoyed doing to us a lot.
Yeah, right. And I was trying to just do everything just like I'm supposed to, do it on time, get her done, and yeah. Okay, thank you very much.
Yep, no problem.
Well, I want to thank you guys so much for this. That was chock full of really valuable information. I can tell people got, I mean, I think we all got a lot out of that. And to everyone who's on the call today, I will be sending you this PowerPoint that Kyle and Jennifer put together. That will give you some points of reference as you might have things that you made notes on or you wanted to talk more about. It also has their contact info, as you can see here on the last slide. So if you want to reach out to them to talk more about your personal circumstances, I am sure that they would be able to do that. This is a series that we put together, and I want to thank our sponsors for. We have Traditional Designs as a sponsor of this event, so thank you to Clay and his boss Ron and the folks at Traditional Designs for sponsoring this, and especially want to thank our members from Cordell, Neher Company, Kyle and Jennifer. I appreciate having you guys with us and really look forward to partnering with you on more things. And so thank you for really being mindful of the construction industry as you put this together. We are grateful.
Yeah, thanks so much for having us, and definitely don't hesitate to reach out to ask questions to Jennifer or myself.
Thank you, guys.
Bye, everybody. Thank you.